because I've had a lot of those instances as a younger man, that's why I work so hard at creating new buying and selling opportunities to get into a trade that's already underway. So that's why I got 81 ways to do it. So if you're bullish, you're expecting that initial manipulation. So you're only focusing on worrying about where the low is going to form. If you're bullish, you're only worried about how the daily low might form and where it might form at. You're not trying to predict the closing price, because chances are your closing price might be lower than it actually is, and it could just keep going higher and higher and higher. So you go into an understanding of the daily candlestick forming by understanding what the monthly and the weekly and the daily charts are indicating. If you had a down close day yesterday, chances are, if everything's still bullish, you're probably going to have an up close day today. That means at 9:30, using the NQ, ES, and Dow futures as a medium to talk about this. At 9:30, what I'd like to see in that situation is an initial small little rally higher to get people in buying long. And then they drop it down into a discount. Some overnight low, relative equal lows, some overnight sell side liquidity pool, or maybe a fair value gap that's formed between, 2 o'clock in the morning to 9:30. And if it also overlaps with a new day opening gap, new week opening gap, or a first presented fair value gap from the previous day, chances are that's going to be the low of the day. But the key is if I'm bullish, I want to see two things happen. I want to see a small little minor rally first that trips in buy-side breakout artists. They're buying on a stop. And then they're going to look for the most recent swing low. That's where their stop loss is. Well, that's where it's going to do this to and through. So it's going to jump a little bit, look like it's going to go higher. The public will chase that, even if they don't have an order that's going to buy at a breakout on a 1 or 5 minute chart. And then it drops and it stops them out, and it stops out anyone overnight that may have a long position on. That's the perfect scenario for a Judas swing on a classic buy day. Is that complicated? If you're brand new and this is the first time you're listening to me, it probably does sound complicated. But if you've been with me for a little while, that's an easy recipe. It's easy. If you don't have a confluence of those factors coming together, where at least 3 things are telling you something there, not just a PD array, there has to be something else there. Time, you're inside that opening range between 9:30 and 10 o'clock. You're seeing buy-side trip initially, and then they get rigged across the goals by the drop down, which makes the low of the day. It trades into an overnight, which means London session, 2 o'clock in the morning to 9:30 opening bell. Some low there. It doesn't have to go to the lowest low of London either. So at 9:30's opening price, you'll see a little fluctuation above it. It takes buy side, and then you'll see this little tail that's dropping down. When you're zoomed in on these 1 minute charts, like you see every live streamer has their charts zoomed in real close, they're never seeing it form because they're too close to the trees to see the forest. So that's why you have to have one time frame that's zoomed out a little bit, like a 15-minute time frame. It gives you a perspective that you wouldn't otherwise have because you're zoomed in on these 1 minute charts. And every individual 1 minute candle, or less if you're looking at 15-second charts, you're lost. You have no idea what's coming on and then what's going on. But you focus on one side of the range. If you're bullish, you're looking for the low of the day to form. If you're bearish, you're looking for the high of the day to form. You are not trying to be perfect and time it. You can anticipate it forming in that first hour of trading. So from 9:30 to 10 o'clock, your high or low will form. Majority of the time, you'll see that form in the first 30 minutes. Sometimes in the first few minutes. But the higher low of the day for equities, or indices rather, is going to form in that first 60 minutes of trading. So 9:30 to 10:30, which is not any coincidence as to why I'm teaching my son to focus on his trading being done by 11 o'clock, because he's going to graduate to holding on to a trade past that point based on what he's done in the morning. And he'll trade the whole daily range. While everybody else out here nickel and diming it, scalping it here and scalping it there, he'll do that in the beginning of the day, maybe even pre-session once he gets good. And then he'll nail down the low of the day when he's bullish, and he'll hold based on time. That means he's going to stay on the trade until 10 minutes to 3 Eastern time, minimum, because that's the macro beginning of that last final hour. And then he'll babysit the position after that and trail his stop loss and protect whatever range open profit he has. And that's how you trade the daily range. That's power 3. So I just basically outlined how the market makers and how the algorithm will book that low of the day when it's bullish. They hide the narrative, which is the first thing that they do, by having all these little quirky little short-term fluctuations in price. And they run buy side first to get people caught in. And then when it starts dropping down, people that wanted to buy that day, they're scared to now buy. So they're hiding the narrative. But they're engineering liquidity. Because some people will say, okay, I was wrong. Let me now go short. Where are they going to put their short at? Wherever they can get in it, because they're going to chase. So where are they going to put their stop loss at? At the high of the day that's formed so far since 9:30. So what is that doing? They're engineering liquidity. They're engineering liquidity above the initial high of the day after 9:30 opening, when it's a bullish day. Everything I'm saying here, just reverse everything when it's going lower. It's very simple logic. But they provide a false narrative. It looks like it's going to go down for the day. Oh, look, it went up. It broke resistance here. So it should have went higher. No. No. That's them hiding the narrative, and they're providing a false narrative that here's resistance broken but failed, and they drop it down. And usually it looks real quick and fast. That is inspiring what? Excitement. It's excitement. You walk into the casino, nobody's winning anything. All of a sudden, boom. They get everybody fever pitch. I'm going to get lucky now. Why? Because listen to that noise over there. Everybody's screaming, hollering, clapping because this guy just finally got the payout on the Jeopardy slot machine. He just made $10,000. Look at this. Woo! Yay! Man, I'm feeling lucky now. How the hell does that have any bearing on what you're going to do in the next machine you put money in? It has none. But they know it excites people. It gets them excited. So they're going to start doing what? Putting more money in the machines. Bet more on the tables. So when they give you that Judas swing, when it's really technically on the monthly, weekly, and a daily chart, it's bullish, you should be hunting the low of the day. So you're expecting some little broken wing attempt to trick people going in right out the gate, going up. Never chase that. Never chase it. There will be instances where it does that, and it never creates a Judas swing. It just starts right from the opening bell and goes up. But it's a rarity. It's so rare, you should not even worry about it. And that's why I told you in this mentorship, sometimes when the market just starts trading higher, it'll run without me. I don't need that move. I'm going to let the move come to me. I'm not going to pursue it and chase it down. If I got to chase it, it's not in love with me. I want my setups to love me. It's going to run to me. It's going to want to come to where I am. It's going to chase me down. I'm waiting right here for you, love. And if you don't want to come to me, see ya. You went back to the streets, bitch. You got to go. So, hiding the narrative, engineering liquidity, and then providing the false narrative. That's the Judas swing. Makes it feel like the market's going to go lower. It's not. It's just going down to go up. So you're focusing on a bullish scenario. You're hunting and stalking. Where is that low of day forming? It's going to form in that first 60 minutes. Don't take my word for it. Back test that now. Now you have one more piece of information that you can go through all your charts and see how much validity is there. How much truth is in that statement I just gave you? Then what it does is it delivers price to retail liquidity. That means once it makes its low, it's ran overnight stops. So if they're long, they're not going to be allowed to participate in the now profit leasing of the move higher that creates the daily range going up and closing higher on the day. So now that liquidity that would have been used to protect early longs over the London session, they get stopped out. So they're not allowed to be in that move either. That's what the algorithm does. That's what the market makers asked of the coders. It needs to do these types of things. Unseat the potentially profitable. Because if you unseat them, Their orders to protect their position is a order entry mechanism to pair smart money with that entry price. So they're buying at a willing seller at a deep, deep discount. That's the basis of why sell side is a factor. That liquidity, yes, it's a form of protection for you and I and anybody that employs it to say, I don't want to lose more money that goes beyond this level or price. But the market maker cannibalizes traders that use that logic when they want the range to go a specific direction, higher or lower. In the first 60 minutes, they're using that mechanism of the Judas to go down when it's bullish to absorb all the sell stops that it can, because it floods the market with what? Market orders to buy, which is easy to pair up with that sell side that's being flooded to be market orders that come in, sell at the market, because every sell stop, when it's activated, becomes a market order to sell at market. Well, who's willing to buy that? Someone that believes the market's going to go up from that low, deep discount price. Who might that be? Smart money. The market maker has control and ownership of the algorithm. They have the rights to control and manipulate and manually intervene in price. Most of the time, it's pre-scripted AI delivery of price, the low and the highest form. And the script just runs. Now, you're thinking, this can't be true because I can see orders on the depth of market and the ladder and yada yada this and yada yada that. Okay. Why is that big block of 500 or 300 or 200 that just sits outside of the fair value gap that it trades down to perfectly to the tick, but it doesn't go down to that block of orders that level 2 splashing? Why doesn't it go there? If it's buying and selling pressure, why wouldn't the market just skip right down there to those orders? Oh, now you have a problem. You have an argument to wrestle with, because I'm telling you, level 2 data, depth of market, all that bullshit, that's a red herring. It's to make you think you have x-ray vision, that you have some kind of superpower. You're now on the same level playing field as the market professionals. When I say that, I'm not talking about Goldman Sachs. I'm talking about smart money traders, the people that don't do courses, the people that are not on CNBC, the people you're never going to meet. They don't have name tags. They're not LinkedIn. They're not out there trying to promote that. They don't go around calling themselves a smart money trader. That's me dubbing what they are. Who are they? They are people that understand this algorithm. They understand what price is going to do before it does it. And they know how it cannibalizes retail traders. Not just retail traders like you think, like Tom, Dick, and Harry that's just recently started up trading. They cannibalize the Goldman Sachs boys. They cannibalize every institution out there has a role in that. It's not just any one, all of them do it. They all fall victim and they also participate. But there is a class of traders that are never identified. They're never identified. They're never drawn any attention to themselves. And they're constantly in these markets all day long, reaping and reaping and reaping. And you never hear anybody talk about them. I mean, I'm the first one to talk about them. And I get labeled a crackpot. But how the fuck is it that I can tell you to the tick how these markets are going to behave? How could I possibly know those things? How could that happen? Randomness? I learned these things from other books, is that what you're saying? Because find that shit in the books. It's not there. And again, if it was based on those things, somebody else could trade like me using that same stuff and just say, oh, it's just Elliott Wave. Oh, it's just pitchforks. Oh, it's Gann. Or it's Hurst cycles. Or it's whatever. Fill in the blank. I haven't even showed you anything yet. And I've already blown your socks off. People are already finding setups immediately using what I've taught so far in this 2024 mentorship. They're immediately finding setups. And they're like, what the hell, dude? It's been like this the whole time? Yeah. For 30 years, it's been like that. 30 years, it's been like that. And I'm loving the fact that I can live vicariously through all of your moments when you see it happening and you're like, oh, I know exactly what this is about to do. And boom, you can do it. That's exciting to me. I get my rocks off with that because just because I can see it happening, making money is not exciting. That's not exciting. Seeing other people become passionate about their life, their future, that they're inspired by now this new talent and skill, that they know that they have something that can feed themselves and their family, and they can pass it on to their children. And fuck college, because they're institutional centers where you're indoctrinated to believe stupid shit. You need to be a free-thinking, independent thinker. And you can only do that if you can carve out your own paycheck and you can say how much you're worth. If you submit yourself to somebody else and say, I'm going to give you all my time this week, and I'm going to let you tell me when I have to be here and when I can go home, and how much you're willing to pay me, I'm going to accept that. Fuck that. That's not me. And if that's you, good luck with it. But that's not what I'm teaching. I'm teaching you how to escape that stuff. So once it delivers the retail liquidity, then it's going to start repricing higher. So the first mode of banking profit, these smart money entities, will run those buy stops that are formed after the little initial rally up. So now the new high a day, within that first 30 minutes or hour, they'll run to that. And that deep discount they bought at, they'll offload some of that there. So you'll see prints on your level 2 data where, oh yeah, there's trades taking place. There's always going to be trades taking place like that because the smart money is in there doing those very things. Everybody's also seeing retail traders do what? Chase price. Oh, it's going up. Well, let me just go in there and buy it at the market. You only need one contract traded to print that price. So the algorithm is going to keep doing what? From the time it makes that low of day, it's just going to keep printing, offering higher prices, knowing full well that there's going to be a market order coming in at all times. Then it'll book that price. And if you're short, you're sitting there watching it and you go, okay, I hope it starts going back down now. But the algorithm's saying, no, I'm not. But you're not paying attention to that because you don't believe there's an algorithm. And it just keeps booking higher prices, offering higher prices, higher prices. It moves into a buy program. There's no retracements. There's no gaps. There's no fair value gaps. It just keeps going higher. What do you do with that situation? In your situation, you're losing. You're going to hold on to a potentially open profit that is eroded. And as it keeps marching up to that initial high of the day, prior to the juice swing lower, then it'll really quick jumps up. Because it doesn't want to let the people that have their buy stops sitting there pull them. Because they want that liquidity there. And what does it do? It keeps them from pulling their orders there. And also that excitement, it looks like it's a breakout. Oh, look at that. Oh, it's a breakout. And now you'll see the price really start to take off because they don't want everybody being able to pile in on those deep discount prices because they want to get it quicker to the high of the day. So classic buy days, they don't spend a lot of time near the low. There's a whole lot of energy that takes off when it finishes its Judas swing. It goes, bang, takes off. So you have to be positioned at that initial high of the day prior to the Judas swing. Anywhere from that high down, being long, is ideal. And be comfortable knowing that you probably will never see that range from the initial high being taken out to the Judas swing low. You'll never see that range that creates that ever traded to the rest of the day. So you don't have to have your stop loss at the low of the day. You can go back 3 PD arrays in that range, put your stop loss there, and just let it go. Go do something else. Go do something stupid like play golf, tear up your back. Go do something that's fun, like go fishing. Go take a nap. Go take your spouse out or your significant other. Go have lunch. Don't even look at your charts. Just let it go. And then come back 10 minutes to 3 and see how much of the range you now have under your trade and how many times that you may have done something silly and small little short-term little moves and never had the whole daily range.